Good evening from Kuala Lumpur, and welcome to the second day of this conference jointly hosted by the Asia School of Business and the Bank for International Settlements on digital disruption and financial inclusion, challenges and opportunities. My name is Kirtma from Mongolia, and I am a Master of Central Banking student at the Asia School of Business. We will begin shortly, but first I want to invite you to the Q&A function at the bottom of your screen to ask questions. There will be some time for questions toward the end of our today's session. As well as asking questions, you can like other people's questions, which will push them to the top of the list. It is my honor to introduce today's chair, Governor Benjamin Jokno, the Governor of Banco Central ng Pilipinas. Prior to his appointment as governor in 2019, he served as budget secretary from 2016 to 2019. He served as budget secretary from 2016 to 2019. As governor, he has been a champion of digital payments and financial inclusion. Earlier this month, the Banker magazine named Governor Jokno Global Central Bank Governor of the Year 2022 for his proactive leadership, prompt and extraordinary policy response to the COVID-19 crisis. Without further ado, I will now give you your chair for this evening, Governor Benjamin Jokno of Banco Central ng Pilipinas.
Good morning, good afternoon, good evening, ladies and gentlemen. I wish to thank the organizers of this virtual conference for inviting me to chair today's panel session on a timely topic, financial resilience in the large and in the small. Indeed, as the COVID-19 pandemic continues to challenge our respective economies, financial conditions, and way of life, we need to discuss the state of financial resilience of governments and businesses, as well as individuals and households. The COVID-19 pandemic has hugely impacted the financial health of governments, businesses, households, and individuals. The disruptions and restrictions caused by the pandemic resulted in unprecedented challenges to financial health, ranging from strained fiscal resources for governments, lower sales and profits for businesses, constrained incomes for individuals and households, as well as difficulties in debt servicing capacity for many. Because of this, today's discussion matters, as it will bring to the forefront of global conversation important issues and concepts on financial health and resilience, which hopefully will help us policymakers generate useful ideas and policy proposals amidst the challenging environment of the pandemic. This conversation will also be worthwhile to listen to, as we have a roster of highly knowledgeable and reputable speakers. For our keynote address, we have a special contribution from Her Majesty, Queen Maxima of the Netherlands, in her capacity as the United Nations Secretary General's Special Advocate for Inclusive Finance for Development. As a special advocate, Queen Maxima is a leading global voice for advancing universal access to and responsible usage of affordable, effective, and safe financial services for positive outcomes. Last September, a working group on financial health convened by the special advocate released two important reports to help policymakers understand and measure financial health, notably in the context of financial inclusion. On that note, it is an honor to now share a very special pre-recorded message on financial health from Queen Maxima.
Ladies and gentlemen, today's discussion on digital disruption and inclusion and how it affects people's financial resilience and health is incredibly timely. The COVID-19 crisis has accelerated innovation and uptake of digital financial services. This acceleration builds upon a lot of gains in financial inclusion that we have made over the previous decade. Since 2011, 1.2 billion people have obtained an account, and this only measures until 2017, I do anticipate even greater gains when the new World Bank Global Findex is released later this year. Efforts to advance digital financial inclusion, such as expanding agent banking networks and enabling AKYC systems, have resulted in the build-up of necessary infrastructure. This has been critical, especially during the pandemic. Digital financial services have become an integral part of response and recovery efforts in many countries, serving as an effective channel to distribute relief payments to the public. E-commerce and digital payment platforms have also been lifelines for many micro and small entrepreneurs to conduct businesses during these lockdowns. While there are many reasons to celebrate, there's still a lot more to be done. Moreover, the pandemic has highlighted the need to look more holistically at the relationship between the use of financial services and outcomes for individuals. We should ask, does access necessarily equal better financial health? In other words, does it help a person or a family successfully manage their current financial obligations and have confidence in their financial future? If the answer is no, then we are not where we want to be. The issue of financial health is a universal one. People everywhere lack resilience. The 2020 OECD Financial Literacy Survey found that almost half of respondents had no money left at the end of the month. In the developing world, only half of adults can access a lump sum of funds in the face of an economic shock or emergency. So, how is financial health relevant for financial sector policymakers and regulators? And what are their roles in addressing this issue? A financial health lens can provide a much better view of macro and micro trends by assessing the financial well-being of individuals, households, and small businesses. It can also help identify inequalities, especially as it affects vulnerable populations like women or rural communities. Increased financial health can relieve pressure on government safety nets. Deeper financial resilience can result in quicker recovery during economic downturns. A build-up of financially unhealthy populations can signal potential financial sector instabilities. A focus on financial health can also enhance other key policy agendas. First, financial inclusion. Access to financial services can drive improved financial health, but the linkage is not automatic. For example, in Kenya, during a period of increased financial inclusion between 2016 and 2018, financial health declined. When we adopt a financial health perspective, it broadens our attention from access and usage metrics, shifting to outcomes for individuals. Second is financial stability. A buildup of financial unhealthy customers can signal potential financial sector instabilities. Financial health can help assess or offer an early warning on rising debt burdens even before portfolios deteriorate. About 5 years ago in the Netherlands, we started a debt lab to help people reduce over-indebtedness. One key lesson we learned was to be on the outlook for those early warning signs. Here, the first red flag is often when a person stops paying health insurance premiums. Third, we need consumer protection. A financial health lens can support how oversight bodies assess consumer risk and better understand how products in the market contribute to positive or negative customer outcomes. It can also help evaluate product suitability or detect emerging poor practices, such as predatory lending. Fourth is financial education and capability. Good financial health is a desired outcome of efforts to enhance people's financial planning and saving habits. However, financial literacy alone does not guarantee positive outcomes. Knowing does not always lead to doing. For example, South Koreans score higher than the OECD average score in overall financial literacy. But less than half indicated that they track their finances or have long-term financial plans. There is a need, therefore, for more effective interventions. Finally, there are important linkages to other social and economic policies that are key factors for financial health, including social protection, employment, and healthcare. We need to broaden the policy dialogue and coordination beyond just financial sector actors. Ladies and gentlemen, to properly address financial health, start with measuring it. Measurement is key to understand the scope of the issue and can better inform policy actions. Today, however, what typically gets measured are macroeconomic indicators like GDP, consumer price index, and so on. Yet many of these metrics fail to reveal the state of financial health at an individual level. We need more nuance so that we can genuinely measure the current situation as well as future progress. Measurement should take into consideration the local context, but it could also benefit from methods that would allow benchmarking across countries. My working group on financial health produced a report that outlined measurement approaches. These can be further adapted into local contexts. The working group also holds ongoing discussions around global measurement standards with leaders such as OECD and the World Bank. I do encourage you to reach out to my office to access our resources and join our efforts. While the connections between financial health and policies have been explored extensively in some high-income economic countries, more work is needed. This is especially true for emerging economies. It is important to look at financial health distinctly at the micro and macro levels, and even more crucial to understand the important linkages between the two. We need to better understand what are the main drivers of financial health in a given country. In the United States, for example, medical debt is the most common kind of debt in collections and the most common cause of bankruptcy. About 8 million people were pushed into poverty in 2018 due to out-of-pocket medical expenses. We also need to understand how financial services and different financial services contribute to financial health, both negatively and positively. We are seeing signs, for example, of over-indebtedness through digital credit in some markets such as Kenya, Tanzania, and more recently, India. The scale of consumer risk from digital finance is growing faster than the adoption rate. These risks could create financial shocks for consumers that will reduce their resilience and affect their financial health. And we need much more research to explore the empirical linkages between financial health and financial stability. A better comprehension of financial health in a country can help policymakers and regulators craft more precise interventions. For policymakers, that means make financial health a core purpose of financial sector policy. For instance, the Central Bank of the Philippines has worked on a national strategy refresh with a vision towards inclusive growth and financial resilience. It identifies improved financial health as one of its main desired outcomes. Policymakers also need to be sure that there is sufficient focus on vulnerable groups. For example, again in the US, the financial health gap between men and women has widened during the pandemic. Therefore, the government could tailor policies to women's financial health needs. Additionally, it is key to design social protection programs with resilience in mind and ensure that default options for government programs encourage financial health. For example, automatic enrollments in pension savings. And for regulators, use financial health as a lens for financial sector oversight, especially consumer protection. By limiting loan products that feature repetitive short-term borrowing, we can protect consumers from credit products that encourage over-indebtedness. Financial authorities can also create incentives and enabling environments, such as market data or a regulatory sandbox, for providers to offer innovative products and solutions conducive to a good financial health. Regulators can also drive private sector involvement and accountability, build standards and incentives for companies to measure and compare the financial health of their employees, customers, and clients. In conclusion, financial health is a critical matter for individuals, households, and small businesses everywhere. Elevating financial health as a priority policy and regulatory agenda can significantly contribute to improving their well-being, as well as strengthening resilience at micro and macro levels. Ladies and gentlemen, I really wish you fruitful dialogue. I look forward to contributing with you throughout this important journey. Thank you very much.
Thank you, Queen Maxima, for discussing how financial health can enhance other key policy agendas. Indeed, Her Majesty's advocacy in this regard is certainly helping to bring financial health to the forefront of global policy attention, an important part of ensuing global conversations on recovery and reforms that are necessary as we emerge from the pandemic. Our next speaker will be Dr. Leora Clapper, lead economist in the finance and private sector research team of the Development Research Group at the World Bank. Also a member of the UN SGSA Financial Health Working Group, Dr. Clapper has several publications focusing on corporate and household finance, banking, entrepreneurship, and risk management. She's also a founder of the Global Findex database, the world's most comprehensive data set on how adults borrow, make payments, and manage risk. Our financial inclusion policymakers have greatly relied on the Global Findex as a source and tool for our own research and policy work. Ladies and gentlemen, may I call on Dr. Clapper to give her presentation.
Thank you, Governor. Can you see my screen? Thank you. It's a pleasure joining you today. I work at the World Bank at the intersection of research, data, and policy. And most of my ongoing academic research relates to the impact of digital financial services on financial health and resilience, especially for women. Interest in financial health was heightened with the onset of COVID-19, which placed the spotlight on the challenges people face in managing their finances under the stress of lost income and jobs. Today, I'll discuss findings from data collection efforts and rigorous research on ways to measure and improve the financial health of individuals and families. Let's start with definitions of financial health. There's no magic number. Rather, it's necessary to take a holistic approach to measuring individuals and families' financial decisions, their goals and challenges. For example, one branch of literature is interested in people's knowledge of basic financial concepts like inflation, interest compounding, and risk diversification. A second branch adds on people's reported risk appetite and awareness of financial products like insurance. More recent work has gravitated towards actual and predicted financial behavior. For example, as shown here, as mentioned earlier, the Global Findex data, which I've been collecting with the World Bank team since 2011, measures how likely people are to come up with emergency financing and the source of the money. In developing countries, people report turning most often to family or friends by trying to find additional work. Under the guidance of Her Majesty, the UN SGSA Financial Health Working Group identifies 4 aspects of financial health. First, the ability to meet day-to-day financial obligations. For example, helping wage workers paid monthly stretch their money to the end of the month without needing to skip meals or borrow. Second, financial resilience to manage the loss of a job or unexpected health or other emergency. Third, the ability to set financial goals. And fourth, having confidence to make financial decisions. In developing countries, this might mean making a financial transaction, like withdrawing a government support payment without the help of an agent who might ask for an informal payment, or a family member who might take control over the money. Let's next turn to see what the data says. This slide collected with Anna Maria Losardi shows that globally, only about 1 in 3 adults could answer correctly 3 out of 4 simple questions on inflation, interest rates, discounting, and risk diversification. But a challenge of this measure is that it doesn't really tell us if or how this knowledge affects financial behavior. The data might identify and flag some hidden risks. For example, this figure shows the percent of adults that could answer correctly 1 out of 2 simple questions on interest compounding, and suggests, for example, that many adults using credit cards are unaware that interest rate payments grow exponentially over time. In addition to educating consumers how to calculate interest compounding, this information may also inform policymakers to require greater disclosure by lenders or to display expected monthly payments instead of only showing the APR in small print. Another way to look at financial health is resilience to lost income. Recent studies use available data on household consumption and asset holdings comparable across countries. This measure is a simple interpretation. Conditional on an economic shock resulting in a complete loss of income, it's the number of months that a household can maintain its level of consumption by relying solely on its liquid financial wealth. This figure shows that the share of households whose resilience to a total income loss falls below 3 months, 6 months, and 1 year, for a sample of 24 emerging advanced economies for which comparable data are available. The data reveals that the percentage of households not able to sustain basic consumption beyond just 3 months is higher in emerging economies and advanced economies, where 40% of adults could sustain consumption for 30 days. However, the percentage of households that cannot self-sustain beyond 1 year is practically identical, reaching about 70% in both emerging and advanced economies. And reported resilience might be overstating people's access to money in case of an emergency. Let's look back at the source of financial resilience in the Global Findex data. As discussed earlier, most people would depend on family and friends, or by trying to find additional work, which might not be available. It's also important to understand the source of savings. For example, in Pakistan, 20% of adults say they would use their savings. However, 90% of these adults report only saving in formal ways, like in their homes, under their mattress, where the money may not be when an emergency hits. Notably, less than 20% of adults in low-income households report using any savings or borrowing in case of an emergency. This highlights the importance of financial inclusion. In addition to the importance of using an account to save and borrow in order to invest in educational, business opportunities, adults are more likely to smooth out their consumption and to improve their financial resilience if they can save and borrow. As the governor discussed in his introduction to this session, it's important to frame today's conversation around the global pandemic that continues to rage around the world. The economic disruption caused by COVID-19 health crisis quickly turned into the largest global economic crisis seen in more than a century and continues to disrupt economic activity. For example, one sign of Omicron's workforce effects. In World Bank household pulse surveys from December 1st to 13, 2021, a representative sample of about 3 million people said they were not working because, quote, I was caring for someone or sick myself with coronavirus symptoms. When asked the same question between December 29th and January 10th, 2022, an estimated 8.8 million people said this. With this in mind, understanding the impact of the pandemic on financial well-being has great urgency. The data I show here was collected late last year by Gallup and shows remarkably that wealthy Americans report greater confidence in their finances than before the pandemic. However, middle-class Americans remain worse off, as do young adults. The regressive nature of the economic crisis caused by the pandemic has put working mothers, workers with less education, and other vulnerable groups in precarious financial position. World Bank surveys collected early in the pandemic show that household incomes and employment were severely affected by the COVID-19 crisis and the public health measures, such as mobility restrictions and retail closures, adopted to contain the pandemic. Survey data covering 51 countries reveals that 57% of firms reduced employment during the first 2 quarters of the pandemic, directly affecting household income. As shown here, World Bank high-frequency phone surveys in 34 low and middle-income countries found that on average, more than a third of respondents stopped working because of the pandemic, and 64% of households experienced reductions in income. This employment income effect on financial health was compounded by a steep decline in remittances in these countries. Over 60% of households reported receiving less in remittances since the onset of the pandemic. The aggregate nature of the economic shock also made it more difficult for low-income households to rely on the formal social insurance on their family and friends that they often expected to rely on. Let's next turn to the academic literature for a rigorous analysis of ways to improve financial health. So competing meta-studies of the literature and the data of financial education cast doubts on the benefits of classroom education. Money management lessons improve skills. Students show greater knowledge of financial concepts, testing, but there's only weak evidence that it changes financial behavior or has a causal impact on outcomes such as over-indebtedness. An important caveat is that education has been shown to be helpful in the right time and the right place. What's working are interventions to improve financial capability that leverage teachable moments, such as when adults are applying for credit or when women are receiving a government payment, excuse me, or when a worker receives a visa to work overseas. In other words, financial education is most effective when it's salient to the person receiving the information. Other studies try to improve the delivery of financial education through tablets, texts, and soap operas. These all have short-term impacts. For example, when a popular soap opera in South Africa included a storyline where the main character called an over-indebtedness hotline, calls to that number surged. However, none showed long-term effects. My takeaway from this literature is that first, the key to success is finding the salient teachable moments. Second, financial education can successfully impact behavior in the short run. An intriguing question is whether education, technology, and ongoing experience using financial services can enable an impactful combination. And so where are some of these opportunities? So since 2011, the highest we find in the Global Findex database that the highest rate of account ownership in the developing world is found in Mongolia, where in 2017, 93% of adults had an account. Adults in Mongolia also score high on financial literacy tests and usage of accounts. Over 85% of adults make or receive a digital payment. We didn't have any obvious explanations, so I went to Mongolia to ask them. That's me sitting on the rug. Interestingly, all Mongolians receive small cash payments starting from birth that go directly into an account and can be used by young adults for schooling, investing in a business, etc. So growing up, the people I met with watched their money grow in an account. They now check their balances regularly using their phones. They've developed trust in the financial sector. They make and receive digital payments and have become savvier financial customers. And technology was a key to this learning. A very nice experimental paper offered debit cards to some government transfer recipients in Mexico. They found that these recipients used their cards to continuously check their balances by themselves for months to make sure that the little savings they kept in their account was still there the next time they checked. After about 6 months, they gradually started using their accounts to save a little money every month and grow their balances. Recipients received financial education training at the start of the program, and the debit card allowed these people to build upon their financial education, improve their financial knowledge and capability, and their financial health. In my recent paper with Emily Briza and Martin Kans, we show that low-income garment workers in Bangladesh similarly build financial capability over time by receiving wage payments into an account, as compared to workers who randomly received an account but continued receiving their wage payments in cash. The workers who randomly received digital wage payments learn over time to use the accounts on their own. Many factories, garment factories around the world, were forced to pay workers electronically during the COVID-19 lockdowns in order to receive government support and when workers returned to their villages. And are continuing to pay workers electronically to avoid the contact and expense of paying in cash. In Bangladesh, for example, over 1 million workers started receiving digital wage payments during the pandemic. As I'll discuss, by providing ongoing financial education and support, this is a tremendous opportunity to improve the financial health and capability of low-income workers. For example, in our study, first, we find that workers paid into an account more than double their savings as compared to baseline, and that the savings comes from a decrease in discretionary spending on things like snacks. These workers are also less likely to report income shocks at the end of the month, like skipping meals. We find no effect on workers only given a bank or mobile money account, but who continue to be paid in cash. We provided financial education to all workers who received an account at the beginning of the study, but find that only workers receiving payroll accounts learn to use their accounts for withdrawals and to send remittance payments to family themselves from their mobile phones, thus learning to avoid potential exploitation and illicit fees charged by commissions-motivated agents. Finally, we find suggestive evidence of the spillover effect of digital payroll on the community. We sent actors posed as workers to local mobile money agents around factories that paid cash, as compared to factories that paying electronic wages. We found that agents around the factories paying digital payroll were less likely to add on additional fees to customers. In other words, receiving digital wages made workers more savvier financial customers. And there's growing academic literature on the benefits of digital payments. Digital payments offer greater privacy, security, control over the money, especially for women. We met a garment worker in our study in Bangladesh who said to us, "My mother-in-law waited outside the gate for me on payday. Now she can't." Digital government payments can reduce corruption and administrative costs. For example, in Niger, a study shows that distributing government social benefits digitally via mobile phone instead of through cash disbursements cut administrative costs by a fifth and reduced ghost payments. Or in other words, money was more likely to go to intended recipients. Digital payments is also linked to higher savings and greater financial security. So where are the opportunities presented by COVID? The World Bank has documented over 200 countries that planned, introduced, or adapted more than 1,000 safety net payments and other social protection measures for the most vulnerable populations, including women. So many governments are using digital channels for COVID-19 relief payments, and it's going well in some places. For example, in West Africa, where mobile money accounts surged in the past 5 years, Togo built a digital cash transfer program to provide monthly aid to informal sector workers. Despite the challenges of reaching workers without formal documents, the program was set up in just 10 days and reached 12% of the population. And so though it's important to recognize the importance of the fourth pillar of Her Majesty's definition of financial health, the importance, especially for women, to have the skills and confidence to use an account on her own. This data is from a Center for Global Development study that found that after Bangladesh switched to making a payment to mothers directly into a bank account, most mothers reported being better off, but not all. Mothers who are illiterate or innumerate complained that they were worse off, perhaps because they couldn't get the money themselves, instead needed to send their husbands to get the money for them. About 10% of mothers didn't live near a cash out point, and because of family responsibilities and social norms, couldn't travel to get the money themselves. A more recent example is Colombia, which made digital COVID-19 relief payments, impressively reaching nearly 2.5 million adults, including almost 1 million adults who were previously unbanked. The government was able to deliver aid payments on time with social distancing and reduce delivery costs. Beneficiaries were able, without leaving their homes, to use these accounts to pay public services, to charge their cell phones, make transfers to family members, and make purchases and electronic payments. But a World Bank survey found that new users had trouble navigating the app, suggesting a need for greater support, ongoing support, and attention to product design. And that most recipients completely cashed out their payments. Of course, many families might have needed all the money immediately for food and other urgent family needs, but an ultimate goal is to help families keep the money electronic and safe. The last evidence I'd like to bring into the conversation is around social networks. My co-author Sumit Agrawal discussed in yesterday's session our new study showing that low-income workers learn to optimize the exchange rate of the remittance payment by using a fintech over time and through the experience and expertise of their social network. Specifically, although these workers typically have little formal education, their personal experience using the fintech and the experience of the workers' social network increase the frequency and efficiency of workers' use of a feature to help them save money sending money home. This highlights how peer effects is another important channel to spread financial skills. And as shown in this figure, one of the most striking examples of digital payment adoption during COVID involves the abrupt shift in remittances from being mainly in cash to more digital forms. The title of a Forbes article from last May, "How Money Transfer Companies Squeeze 4 years of digital growth into just 2 months," sums it up. The shift offers big opportunities to improve the financial health of both senders and family members back home receiving the money into the account. And so let me end with the importance of strong and enforced consumer protection provisions. People have good reasons to mistrust financial institutions. Mystery shopper audits in Latin America and sub-Saharan Africa revealed that loan officers failed to provide consistent information on costs, that inexperienced borrowers got less information than experienced borrowers, and that printed material on borrowing costs were missing or failed to meet guidelines. The onus for good financial behavior should not rest exclusively on customers or on financial education. Consumer safeguards are critical for building public trust in the financial system so that people use their accounts to build financial security. For example, requiring clear and easy to understand product terms may be especially important for low-income women, given their relatively limited financial experience and capability. There's evidence to support this. Experiments in Mexico and Peru found that bank customers presented with simplified statements about credit and saving products made better financial choices. Regardless of how literate they are, people cannot make good financial decisions if they're given inaccurate or incomplete information. But perhaps technology, such as text messages, can cheaply provide ongoing support and information to improve financial behavior. For example, governments and financial service providers can partner and leverage technology to make it easier for government transfer recipients to know the amount of money they should be receiving, the closest operating cash-out point, and expected fees. This is an exciting time to be working, and we hope to see great strides in financial health. So thank you, and I look forward to our discussion.
For that presentation on financial health and resilience. As policymakers, we look into policies and initiatives that will build financial resilience as part of our financial inclusion strategies. Based on your presentation, building financial health and resilience, particularly among the financially excluded, mitigates the effects of shocks to income and consumption. Thus, supporting the development of financial health and resilience can certainly help us navigate our way out of the pandemic. Now let's move on to our next speaker, Mr. Dilip Asbe. Mr. Asbe is presently the Managing Director and CEO of the National Payments Corporation of India, an initiative of the Reserve Bank of India and Indian Banks Association under the provisions of India's Payment and Settlement Systems Act of 2007. He has played a pivotal role in designing, building, operationalization, and management of large-scale payment processing platforms like Unified Payments Interface, Bharat Interface for Money, Immediate Payment Service, and India's homegrown card network, RuPay. He has been involved in setting up payments infrastructure like the National Electronic Toll Collection, RuPay International Debit and Credit Card, direct benefit transfer platforms using Aadhaar payments bridges, and he has been instrumental in designing Aadhaar-enabled payment system and defining micro ATM standards for interoperable financial inclusion along the team at the Unique Identification Authority of India. So, ladies and gentlemen, may I now call on Mr. Mr. Asbe.
Yeah, thank you. Thank you so much, Governor. Let me start my presentation, and I will cover it in 3 parts. So the first part I will speak about, how a country can actually leverage the technology, the innovation, and the setting up of vibrant ecosystem can help the country to take the financial inclusion and effective use of digital technologies to create a great example on having a latest modern financial payments infrastructure. So when we look at the second part, I will speak about the India context, and third part is how the UPI can support the world. When you look at the technology, last few years, we have seen a tremendous amount of change in technology, be it the open source technologies which has come up, which allows a fintech or a bank to build up the front end app, the back end infrastructure in a very low cost. When I say low cost, 1/10 of the cost it would have costed about 7-8 years back. The second big change is penetration of smartphones. The penetration of smartphones worldwide trend has been very, very encouraging, and we believe next 5 to 7 years time, about 70-80% of the world population may have the smartphone in their hands with the data access. When we look, the other aspect which has evolved over the period is the cloud technology, which has enabled again to the fintechs, banks, to not to build the infrastructure by themselves, but to avail the cloud technology to build up again, both from a time perspective and a cost perspective, a very effective and efficient infrastructure. Now, when we looked at this 2 or 3 technologies which has dominated the last decade, we certainly believe and know that the next decade belongs to the artificial intelligence, which is using the large amount of data for the decision making, real time, fraud risk management, the cross sell or variety of the decision making which the financial institutions can use, and also the decentralized technologies to create the trust, to create the kind of take advantage of DLT platforms to provide the financial services in a big way. Now, when we look at moving to the second point, which is the innovation and how the innovation can support the country with a balanced regulation. When you look at the innovation and regulation, both must go hand in hand. While we look at the technology changes last 10 years, this technology changes can be fully leveraged, provided the regulation is innovation led, the policies of the country are the innovation led. So it's both hand in hand, and it has to be hand in hand for a reason, because what it brings in is many non-bank entities, which is mainly the fintechs, the big techs, the startups, actually starts taking part in providing the financial services to the end customers. Most of the countries have a bank-led financial system for right reasons, and for the effective innovation in the country, it is critical that the innovation and regulation must go hand in hand. And while the regulation is, if the regulation is not innovation led, or the policy making is not innovation led, obviously having just a innovation is not going to be sufficient, because at the end of the day, the trust in the payment system, the safety and security of the payment system is the ultimate goal of the regulator and the government, including the charges or the cost in the financial ecosystem. The last but not the least, the ecosystem building is super critical, super important for any payment system or a digital financial inclusion at scale. And when we talk about the ecosystem, it is necessary that ecosystem of diverse players is very important to have innovation and drive the competition or a competitive, give the competitive advantage to the players who are innovating a lot or who are scaling up fast. When we look at the ecosystem, automatically it has a great impact on customer experience, because once there are many innovations happening back at the marketplace, everybody tries to kind of look at providing those innovation, and we have seen that overall customer experience improves dramatically when there are diverse players of the players are participating back into the ecosystem. And it's very important that public-private partnership, and many countries are great examples of that, especially the developing markets, that the public-private partnership is kind of important to provide the scale and provide that advantages of the balanced ecosystem to the country. Now, when you and obviously everybody knows that when you look at the ecosystem, it means that it can support a vibrant fintech ecosystem in the country, and it can support the job, it can support the wealth creation, it can have the positive impact onto the overall economy of the country. Now let's drive back to the India context, which is the second part of my discussion. Now, when we look at India, there are 4 or 5 things happened together. The first is multiple efforts were initiated at the same time. Obviously there is no silver bullet in this. So there were multiple efforts at the national scale were initiated by the government and the regulator. A decade back, RBI started NPCI, which is a not-for-profit or a public good, which is an institution as it was explained in the introduction, the entity which was set up to process the retail payments in the country. RBI put in a lot of efforts and nurtured this institution, NPCI, to be a successful institution. and regulators backing support was extremely critical to have the success of country in terms of digital payments, because NPCI predominantly contributed to the success of the digital payment ecosystem that exists today in India. The government started the Jan Dhan account opening, right? Poor families, financial inclusion. It opened about in the last few years, it opened about 300 to 400 million accounts, which were very useful and important, which played very important role when the COVID pandemic hurt the world. And I'll explain how. The second is, the government built up the public good infrastructure like Aadhaar and UPI. When you look at the Aadhaar, which is the unique ID or a unique ID very similar to the social security number in United States, but with the biometrics and authentication capabilities, 1.2 billion Aadhaar IDs were issued to our citizens. And now the country has the ability to authenticate and validate the biometrics, the mobile OTP for the 1.2 billion population country. And the regulators embraced this with the regulations to allow Aadhaar as a KYC for the KYC purpose, which drove the big change and which kind of enabled to onboard large number of accounts. It enabled large number of fintechs or startups to use Aadhaar for the KYC purpose, and kind of fueled the fintech growth in India. The last but not the least, the government promoted the Make in India, and the smartphone penetration increased dramatically. And today we have 500 plus million smartphones, which with the active connection now with the strong mobile operators like Jio, which is along with the Airtel. We have Airtel access to about 80 to 85% of the which has the penetration of 80 to 85% of the area of the country, and that kind of creates a suitable environment for the policy creation. Now, all these multiple efforts were initiated at the same time. Obviously, we live in this all happened because we live in the country where Prime Minister, Finance Minister, the RBI, including the RBI governor, has a clear focus on promoting digital payments. And as Ms. Clapper spoke about, the savings, the speed of money, the financial literacy, the criticality of the country to have its own digital payment infrastructure without depending on much dependency on the overseas partners having full control of their payment system is very, very important for the country's progress. And thankfully, all the Prime Minister, Finance Minister, the RBI governor are extremely clear that the financial inclusion and the digital payments are super important back for the country. The second point is the policy making of RBI and the government actually led this whole revolution happen from the front, right? During the COVID platform, while the direct benefit transfer platform, which was built by the NPCI, was used very effectively by the government and provided aid at the right time when there was no income back to the poor and needy section of the society. It provided the direct benefit transfer, and government spent over about $5 billion giving the subsidy back to the poor in India. And that kind of helped immensely to deal with the COVID pandemic and in the absence of any income during the lockdown period. I spoke about the KYC infrastructure, the KYC regulation, the PMLA rules, which came in at the right time. And the RBI played very important role while working with NPCI and the ecosystem to design and create the payment system like UPI, and which needed a very much forward-looking regulation, which while there were many challenges to create a payment system like this, which do not exist anywhere in the world, but it stood by the principles of interoperability and a very low-cost payment system back for the ecosystem, both from a customer and the merchant standpoint. The third part is, while the payment systems were getting built up for the customers and merchants in the ecosystem, the accessibility to the merchants and customer was the very important point, and the regulator and the government both were very vigilant on this aspect. It provided adequate policy attention and policy interventions to ensure that the small merchants are able to accept the digital payments with very, very reasonable cost, with the help of asset-light standards like QR codes and the customer onboarding, right? Today the payment system, the charges are big obstacle for the large-scale onboarding onto the digital payments. So RBI and the government worked with the ecosystem to ensure that very reasonable or minimal or almost no charges back to the customer as far as the digital payments are concerned. So all the platforms which we India built helped to create a fintech and bank collaboration, which was very, very effective with the open architecture. It fueled the partnerships. In fact, India would be the only country where you would see the Google, the Walmarts, there are many players, WhatsApp. There are local players like Paytm, PhonePe. The banks in India have launched the app. There are many such collaborations exist in India to leverage the policy making, leverage the public good infrastructure, what the country has built, and very highly affordable and low cost digital payments for the customers and merchants. So this creates a kind of a base for the entire ecosystem to create use cases, and the country then built up many use cases, whether it's a initial public offering, which is the applications to the stock market, using the application of the applying for the shares using the UPI, whether it's an auto pay, which is the recurring payment regulation by the RBI for the small ticket transaction, which is fairly a kind of initial steps of creating a programmable money in some sort, and the recent regulation, which is the processing the offline transactions below $5 in a offline mode. So variety of the use cases were built up, and the ecosystem actually leveraged the context-free payment system or a public good infrastructures which were built by the country. While obviously it's never enough, and country is still embarking its journey to create the next level, and country has built up the 3 large-scale infrastructures. One is the account aggregator infrastructure that helps to the financial institution provider based on the customer interest, consumer request or consent, provide the financial data to the financial data requester, which will kind of provide them to take a credit decision or a investment decision or a risk assessment on the customer, so that the variety of the services can be offered to the customers which they do not yet entitled to. So this is kind of account aggregators creates a framework for open data. The second framework, which is the OCEN, which is OCEN, which creates a framework for open credit. Today, when you look at UPI, the UPI processes about 5 billion transactions on a monthly basis over the about $150 billion US dollars on a monthly basis. So that kind of creates a base to have a data to make the credit decisions for the banks, for the non-banking financial corporations, to institutions, to provide the lending and grow the credit base and fuel the economy for the consumption purpose. So open data, open credit, and very recent initiative of the country's Open Network Digital Commerce, ONDC is what we call it. This is nothing but an open commerce, right? And today, when you look at the digital commerce or the e-commerce, what we call, majority it is supported by the large infrastructures like Amazon, Flipkart in India, or the other large providers like Snapdeal, Myntra, other providers. But predominantly those are closed loop infrastructures. Today, the government has taken an initiative for the open commerce, ONDC, which kind of enables to even the small stores to participate in the e-commerce or digital commerce space. So there is an effort to create a open commerce with the support of complete ecosystem creation of large app providers, making this entire e-commerce digital by unbundling the demand and supply, so the customers can use variety of the apps and actually look at a digital hyper local suppliers to supply the goods, and variety of creating a supply chain, creating the credit institutions, creating the verification and validation institution layer. So variety of institutions coming together to create the open. So open data, open credit, and open commerce are the three large-scale initiatives which India is currently working on. Now, when we look at what is that India has some to offer to the world, while the UPI Unified Payments Interface is a public good for the India. It had made a remarkable difference, and we believe that we will process 1 billion transactions a day in India in next 3 years' time. The Prime Minister has a vision that why can't we use why can't India, which is using UPI as its public good, why can't we offer as its public good of the world? And variety of efforts have been done. The government has reached out to many governments to look at whether they would need UPI as to be implemented back in their country. The RBI has reached out to various central banks about explaining what is the UPI value add to the India, and if you would like to use UPI for your country. And NPCI is actually now ready to provide UPI as a protocol, UPI as a open source system under the central bank to central bank arrangement, or a government to government arrangement to the interested countries. And the countries can leverage this infrastructure to build up modern digital payments infrastructure in their country, which will have the bank's fintech collaboration. It will not have any dependency whatsoever to anybody else other than outside that country, with no dependency on India, and control the critical payment infrastructure for that country. So that's all from my side. I would like to again thank the BIS and organizers to give me the opportunity to present the India story and the importance of digital payments and the latest technology trends. Thank you.
Thank you, Mr. Asbe, for your insights. To summarize, we noted from both presentations of Her Majesty Queen Maxima and Dr. Clapper that financial health and resilience are key considerations for policymakers, particularly as we continue to work on and pursue financial inclusion. Mr. Asbe's presentation highlighted the immense potential of digital technology as catalyst for financial inclusion. However, we should be on the lookout for emerging risk, which may have an impact on financial health. Financial inclusion strategies and initiatives will benefit from incorporating the objectives of financial health and resilience. This will lead to better outcomes for the underserved and unserved in terms of protecting their income, mitigating the effects of external shocks, and protecting their rights as consumers. Achieving financial health and resilience also bodes well for building the financial confidence of the unserved and the underserved, as we all work to lift ourselves out of the challenges brought about by the pandemic. With those key points laid out, I would now like to open the floor for the panel discussion. Our first panelist is the Governor of the Bank of Thailand, Dr. Seth Aput. Prior to his appointment as governor, Dr. Seth Aput has been a long-time member of the Bank of Thailand's Monetary Policy Committee and served as advisor to Thailand's Prime Minister. He has had extensive experience in both the academe and the private sector in Thailand. As such, we are privileged to hear his views on financial health and resilience. Ladies and gentlemen, let us hear from Governor Seth Aput.
Thank you, Chair. First, let me thank the organizers for having me participate in this session on a very important topic. And let me compliment them on the way they've structured the topic, which is to discuss financial resilience in the large and the small. Typically, often, I think these topics are discussed at separate levels, but I think putting them together makes good sense because there are a lot of linkages between the two. There are a lot of feedback loops between financial resiliency at the small and at the large. If we think it through, for example, in the positive scenario, if we have better financial access that typically allows individuals and households to invest in education and other kinds of human capital or even physical capital, that tends to improve incomes and productivity and has beneficial effects at the macro level, which in turn improves household incomes and then creates this virtuous cycle of financial resiliency. And it's very easy to see how the opposite could be true, that you could easily get with those feedback loops into a negative or a vicious cycle. So treating these two topics together, I think treating this topic together at the micro and macro levels is a very welcome approach. So with that, it seems quite clear that when talking about financial resiliency, it's important to get financial resiliency at both levels, at both the individual or household level and also at the macro level. So it might make sense to start off by, for me to, first of my comments, to try to unpack a bit and talk about what financial resiliency means or looks like at the micro and at the macro levels. So I think it incorporates at least three dimensions. Financial resiliency, I think, at a minimum, includes being able to reduce one's exposure to different kinds of shocks. This is largely an income and productivity story. So the kinds of linkages that we talked about that people at the individual level, people getting access to credit, having improved incomes and productivity, I think is that linkage is fairly clear. A second, so I won't go through that again. A second dimension, I think, of what resiliency looks like would be the ability to withstand shocks and reducing the impact of shocks. And the key concept here would be about making sure that there are adequate buffers. What does that look like at the individual or household levels? Again, that's an issue of savings, having adequate savings, having access to savings products, investment products, having access to credit to be able to engage in consumption smoothing to get through the different shocks. And at the macro or country level, those buffers probably refer to more things like making sure the banking sector is sound, has adequate capital, you have deep and liquid financial markets in order to be able to withstand the effects of those shocks. I think a third aspect of resiliency would be at the micro and at the macro level, ability to recover from shocks. And I think for that, issues revolving around one's ability to limit scarring. So trying to put in place good debt restructuring, good bankruptcy foreclosure framework so people can fall down and get up quickly and move on. The second point that I'd like to make is that from the linkages that we've discussed, I think it's quite clear that financial access can obviously improve financial resiliency and outcomes. But it's probably also quite clear that too much financial access can lead to excessive indebtedness and undermine financial resiliency. We can think of this as perhaps as the yin and yang of financial access, that there needs to be a balance, that not enough is clearly not good, but too much can be a bad thing. And on this note, I'd like to share some of Thailand's experience in this regard, because certainly along some dimensions, particularly in terms of indebtedness, we haven't managed to strike as good a balance as we otherwise should. At the macro level, if we look, for example, at the usual ratios that one looks at for these things like household debt to GDP, household debt to GDP in Thailand increased from about 40% to about 90% where it is now in just about 15 years. So a very, very rapid increase. Fortunately, we have other strong macro buffers. Again, solid banking sector and deep and liquid financial markets. So the risks on the macro front have been manageable in that regard. But regardless, household debt and elevated levels of household debt have been a source of vulnerability for us. At the micro level, and we look at the level of households, what we see is that households have been getting indebted earlier at much higher levels and for much longer. First, earlier, if we look at the data, we see that people as early as 30, about 30 years of age, about 60% of people now have debt. And this is up from 35% just 10 years ago. So people are engaging in borrowing at a much earlier age. And they're engaging in too much borrowing. If we look at about a fifth of those of that age cohort, about roughly 30 years of age, are delinquent, so they're not able to bear that debt burden. And if you look at the nature of the debt that they've been undertaking, a lot of that, or too much of that, is focused on loans for consumption. About 40% of the loans are only for personal and credit card loans, and only about 15% are for home loans. So there's no real asset that can potentially appreciate in value underlying a lot of that debt. And also people are engaging in indebted behavior for much longer. So we see, for example, in data also that we have a lot of retirees who still stop working but still have very high debt load. So what kinds of things have contributed to some of that imbalance? I think in addition to the points that I think previous speakers have mentioned about lack of financial literacy and the importance of addressing market conduct and different kinds of practices in that regard, I point to two other things. One is the role of non-banks. Non-banks, yes, as other speakers have mentioned, are very innovative, but in Thailand, they've also been a very important driver of credit, especially to the young. And we see that there are about a third of younger borrowers that borrow only from non-banks. And so they've been quite innovative in trying to reach previous segments that have been untapped by the traditional banking market. The second aspect is technology. And I think many speakers have commented on the positive aspects of technology for financial resiliency. And there's no question that that's true. We see that technology can lower costs, improve access, but maybe I could dwell a bit on or share a bit on some of perhaps the darker side or the two-edged sword nature of technology. And that is that one thing we've seen is that with the increase in technology and use of digital channels and whatnot, we've also seen an increase in fraud. Things like SMS phishing or also through direct messaging apps and the like have increased sharply as a result of increased use of digital means. And also the advent, I think, of technology increases the chance that marketing can be much more tailored and much more effective than it previously otherwise would have been. I think with large data sets, use of machine learning, AI, will probably soon be in a place where the algorithms might know more about a user's behavior than the user might know themselves. And this increases the risk again that a lot of this technology might turbocharge the supply of credit and lead to some of these imbalances that we have experienced. So my third and last point is then, what is needed then to try to put in place or try to achieve, I should say, a better balance in terms of financial resiliency, and get a better balance of that yin and yang of financial access. And I think there's no magic here. I point to along the lines of what Her Majesty the Queen had said in her opening remarks, that there's a need for a holistic and an end-to-end approach that is needed in order to get that resiliency that we'd like to see. And by holistic, what do I mean? I think it has to address all three aspects of resiliency that we talked about: the ability to reduce our exposure to shocks, the ability to withstand those shocks, and the ability to recover those shocks. And that has to happen both at the micro or individual or household level, and also at the macro or country level as well. And it also has to be end to end. And I think there are a couple of dimensions to that, a couple of aspects to that, which many of the speakers have commented on already, but if I may run through again. First off is as many have referred to, financial literacy. It needs to be, I think, quite tailored and targeted at the vulnerable groups. In Thailand, for example, the indebted groups are not just the young, but they're also not just the urban young, but they're also a lot of old rural farmers that borrow not for consumption, but for farming practices. So the message financial literacy means very different things to obviously those two different segments of the population. So taking a very tailored and targeted approach, I think, is very important. But as again, I think Her Majesty the Queen echoed, literacy alone is certainly not enough. I think the way she phrased it was that knowing is not doing. And so knowing, I might know how to calculate compound interest rates, but if the financial information is very opaque, disclosure is poor, then that's not going to do me any good. So another aspect that this has to be complemented with is I think a clear focus on responsible lending practices, so market conduct issues. And in the case of Thailand, again, I think addressed particularly to consumer loans and the non-bank sector, issues revolving around making sure that adequate attention is placed to on issues of affordability and disclosure. And thirdly, in addition to market conduct, looking at macroprudential measures to avoid excessive debt creation. And fourth, but not least, effective debt restructuring frameworks, ones that strike an appropriate balance between reducing excessive indebtedness, but not creating moral hazard. In Thailand, because our bankruptcy and court proceedings are fairly cumbersome, we have, during the course of the crisis, put a big emphasis on debt restructuring measures. And I'm happy to go on that in more detail, but perhaps in the Q&A session, because I think I've run out of my 10 minutes. So let me stop there. So thank you very much, Chair.
Thank you, Governor Seth Aput, for sharing your insightful views on financial health and resilience from both the macro and micro levels. Now, let me now call on our second panelist, Mr. Yoon Song Shin from the BIS. Mr. Shin has an extensive experience in the academe, where he had previous appointments at Oxford University and the London School of Economics. Mr. Shin also served as senior advisor to South Korea's president, where he assumed a leading role in shaping Korea's financial stability policy and agenda for its G20 presidency. Ladies and gentlemen, let us hear from Mr. Shin.
Thank you, Governor. It's a great pleasure to join you and the other panelists in this very important session. I prepared a couple of slides, and let me bring it up for my presentation. I hope you can see these slides. I think my presentation follows on very nicely from the previous presentations by Leora Clapper, but especially what Dilip Aspi had to say about the payment system in India. And what I would like to do is to draw on some of the work that we did in a previous annual economic report special chapter on the role of central banks in supporting financial inclusion, And I'll give you one illustration of some of the principles through the experience of Brazil, which recently rolled out its own retail fast payment system. So the principle that we outlined in the annual economic report in 2020 was the importance of the central bank's role in providing an open architecture for the payment system, and how the rules of the game, which is part of that provision of the infrastructure provision, can also promote financial inclusion. So the idea is that when we think about the industrial organization of the payment system, the objective would be to transition from a proprietary network where the service provider becomes a gatekeeper on who joins and who then exercises market power as well as control over the data of the users. And the objective would be to move from a walled garden where that kind of market power is in place to more of a public square, an open market, which works according to rules which ensure a competitive level playing field. So this is a photo of the Basel town market, which sets up in front of the red building, which is the Basel town square. And Ellie, of course, knows this building very well. I'm sure this will be very familiar to Ellie. Now, the idea would be to pursue this analogy between the physical market square and the central bank's settlement accounts as a metaphorical market square. It's a public square in that it is an infrastructure that is provided by a public institution, and it's a public provision of a public good. Now, when the central bank provides its settlement account as a public square, there are two roles that this entails. So one is the physical provision of the infrastructure through the settlement accounts. And this is the metaphorical public space whereby within which the various payment service providers can operate and interact with both each other, but especially with the customers on the other side. And this is a market which would be characterized by quite a rich ecosystem of service providers, in that they would all have their particular niche or particular advantage. And the payment service that they provide would be part of a bundle of other services. But the crucial distinction between a walled garden and a setting like this would be that there are rules of the game that ensure that the network effects are designed to promote a virtuous circle of greater competition, better services, and greater entry, rather than a vicious circle, which entails greater market power, greater market concentration, and the ability to extract further data. So how would it do that? Oh, and before we move on, I mean, one important point would be that in India, NPCI is the infrastructure provider, but to the extent that NPCI is working very closely with the central bank and the settlement takes place on the central bank's balance sheet, it is very much an extension of this same principle. So how would the rules of the game ensure that open architecture and the level competitive playing field? The crucial element here is data governance and the technical standards that give effective expression of data governance towards competition. So one aspect of this would be the rules regarding data control or data portability, whereby the control of personal data lies with the individual user, And what this means, among other things, is that the individual can give consent to other service providers for specific applications. For example, when an individual applies for credit. But of course, rules on data portability by themselves will not be sufficient to ensure an open and competitive architecture, because without the technical standards that ensure the effective expression of data in preserving competition, this will simply be a version of a data dump rather than a fully effective expression. The key word here, as Dilip mentioned earlier, is interoperability, which is to say the service offered by one service provider on the platform should be interoperable with the service provided by other service providers. And among other things, that means that you can make sure that there is a seamless connection between the services provided by the individual elements. And because of the interaction on the common platform, you would then be able to ensure competition. In the case of the payment system, one very good example of how you can ensure the open architecture and interoperability is the introduction of so-called application programming interfaces, or APIs, better known through its acronym APIs. And what these APIs provide is a common technical standard for the exchange of information. Now, in particular, there are two APIs that are especially important in the payment system. One is the so-called account information service. And this is the API that allows individuals to open the app of one bank and check his or her balances across all the other banks and payment services providers in the same payment platform. The other API is this thing called the Payment Initiation Service API, where you can open the app of one bank and initiate a transaction from the account at another bank. So essentially, you have the ability to authenticate transactions across all of your different accounts. And what this means is that immediately you break down the possible fragmentation of the payment system. Now, let me give you one example of a very interesting case, which is that of Brazil. Brazil rolled out an instant retail payment system called PIX in late 2020. So this is now barely 1 year old, just over 1 year old. But in this very short space of time, it has gained a tremendous momentum in terms of the gaining users. And to give you a sense, this chart shows you the number of transactions. But perhaps a better gauge would be to give you some numbers in terms of the users of this system. So Brazil's population is around 213 million. But as of the end of 2021, so just barely a year after the introduction of the system, PIX had gained 118.5 million users. And of that, 110 million are individual users, and this is basically 2/3 of the adult population in Brazil, and around 8.5 million of the companies in the Brazilian payment system, which is around 57%. And a remarkable number that I find very encouraging in this context is the fact that of these 110 million new PIX users, 50 million users had not made any digital payments in the year prior to the launch of PIX. So for these 50 million people, they have made a digital payment for the first time in their lives in the last year, which is a really quite a remarkable achievement. I think one of the really interesting developments in this context is the way that this public infrastructure, and by the way, the PIX system has all these open banking features such as AIS and PIS, and it also has the ability to make person-to-merchant payments, the P2B payments, person-to-business payments. And what that's meant is that if you compare the number of transactions on PIX compared to the total number of debit and credit card transactions, we see that in the year or so since the launch of PIX, it has really gained very rapidly on the total number of credit and debit card transactions. And it has already overtaken the number of transactions on prepaid cards. And what this means is that the previous somewhat oligopolistic system that was overseen by the commercial banks has faced this very rapid new entry and this impetus towards lower costs and greater inclusion. And PIX for person-to-person payments is free. It is provided free of charge to the individual. For the person-to-business payments, this is still subject to some fees on the part of the merchants. And we're actually in contact with the Central Bank of Brazil to find out the extent to which those fees have been reduced. If we look at the type of payments, the blue indicates the person-to-person payments. This is the bulk of the type of payment in the system. But the interesting segment is the segment in yellow, which is the person-to-business payments, including the payment to merchants. So I think if I conclude, what I would say is that as exactly as Dilip outlined in his presentation, the role of the central bank and the public authorities more generally in providing the infrastructure for a very important public good can have a material impact on financial inclusion. And I think there is a very strong impetus if we look at this type of initiative and an extension, if you like, a continuum, where the end of which would lead to a central bank digital currency or a CBDC. Because after all, a CBDC is the logical conclusion of the public provision of a public good by the central bank. So let me conclude there, Governor.
Thank you for that, Mr. Shin. Now that we've heard from our panelists, let us now proceed to the Q&A. We received this question from the Q&A box. Maybe we can ask Governor Seth Aput or Mr. Shin to answer. Given the proliferation of non-bank players and fintechs in the payment landscape, coupled with the vague boundaries of roles between the payment service providers, how can policy response effectively regulate and supervise the players in the payment ecosystem without the risk of overregulation and its stifling of payment innovation? Do you want me to repeat the question, or you got it?
That's okay.
Okay,
I'll take a first stab at it, and Shin, you can help add any blanks I left out. It's a great question. My short answer would be not easily. It's something that's very, very difficult. Just to put it in context, take the case of household debt in Thailand. A lot of that household debt we talked about, a good chunk of it is completely in the informal sector over which we have no control. Another good chunk of it comes from these credit cooperatives, which are regulated by the Ministry of Agriculture, not by us. And then there are non-banks, which are overseen by the consumer Consumer Protection Bureau. So again, there are these regulatory gaps that exist amongst the different regulators. So coordination is an issue, and these gaps where certain lenders aren't regulated at all are an issue. And that problem is only getting more difficult with technology. The question cited like fintechs, where the boundaries, again, as I mentioned, are declining. And again, in the context of Thailand, when I heard the question, I was just thinking like, yeah, welcome to my world. You know? In Thailand, we have a digital asset law. The digital asset service providers are regulated by the Securities and Exchange Commission, the SEC, not us. And recently, what we've seen is that a lot of these service providers, the exchanges and whatnot, have moved from treating digital asset as just an investment vehicle, but moved more in terms of using it as a means of exchange, means of payment. You know, getting together with certain business groups and whatnot, and facilitating transactions using cryptocurrency and whatnot. And we've been quite clear from the get-go that you know, our stance as the central bank, as the Bank of Thailand, is that, you know, we do not, the term that we use, we do not support seeing digital assets like cryptocurrency used as a means of payment. And that for us is something and for the usual reasons, meaning that it's not something, obviously, that given its volatility and whatnot, it's not appropriate to be used as a means of payment with its volatility and security and whatnot issues. However, again, that's something that is under another regulator. So just to show you that this is a very live and topical issue for us, just 2 days ago, us, together with the Ministry of Finance and the Securities and Exchange Commission, put out a joint statement saying that you know, this is something that we don't want to see, and that we will start to, through the SEC, start to regulate this to try to ensure that the digital asset service providers like exchanges and whatnot do not use things like cryptocurrency as a means of payment. But again, I think that challenge is just going to get harder and harder. There are hard lines differentiating and separating the different regulators, and just like any kind of bureaucratic organization, it's not always easy to get that coordination to work very tightly. But the boundaries, you know, and this is even before we're talking about like decentralized finance, right, where you put on programmable contracts on things, and then you know what is it? Who regulates it? It starts to become even less clear. So yeah, short answer is not very easily, and you know, I think the next immediate step is I think just you know, the importance of collaborating much more closely across the regulators, and not just across the financial regulators, because well, one thing that we've also seen in Thailand, as I mentioned or touched upon briefly, with this rise of digital use of digital technology and whatnot, is the increase of fraud. And so that suggests the need for us to, or not suggest, we've had to work with other regulators, like in the ICT space, much more closely to address those kinds of issues. And so, yeah, that would be my sorry, not so short answer.
Mr.
So perhaps I could, yes, perhaps I can in here. I think it's a very good question that we have received. It's not an easy question, as Governor Seth has just laid out. I think there are several important issues we need to take into account. Of course, the competitive landscape and the user experience is very important, and it's been a spur towards greater innovation. But in terms of the safety and the soundness of the new non-bank payment service providers, we have first to address the question of access to the central bank's balance sheet. So currently, it's the commercial banks who have direct access to the central bank to the central bank settlement accounts. And the question is, what are the conditions that the new players have to meet in order for them to gain access? And here, clearly, there is a need to set standards that will ensure that the access to the central bank is used in the intended way. The other important aspect, of course, is the fact that banks also combine their payment service functions with the credit function as well. So the deposits are used not only as a payment vehicle, but importantly as a funding source. And therefore, there is a prudential element against credit risk and liquidity risk that also have to be satisfied. And going back to the conditions before a payment service provider gains access to the central bank, clearly these credit risk and liquidity risk criteria will be very important criteria to be actually met in terms of the soundness. Now, perhaps the simplest way of resolving this problem would be to require the new payment service providers to convert themselves legally into banks and thereby bring themselves into the supervision of the central bank or the relevant supervisory authorities. But in particular for the payment system, the central bank would have an important say in the operation and the entry. But of course, that is not the only answer. There could be intermediate contexts. And one very good example is the UK. The Bank of England does allow access to its balance sheet of the non-bank PSPs, but it's not overnight access. It's only during the day that they would actually have access. So there are these intermediate solutions as well. The other important aspect, which I didn't have time to discuss in my presentation, of course, is data governance and privacy. A very, very important part of an open system like UPI or like PIX in Brazil, and indeed the CBDC systems, which are very, very closely related to these open access retail fast payment systems, is the management of digital ID and the privacy provisions that actually follow. And for any non-bank payment service providers, they would need to come up to the very high standards that inevitably will have to be imposed on any payment service provider in that kind of system. And so this puts a very high bar on the standards that payment service providers would have to meet before they're fully embraced into the public infrastructure.
Governor Benjamin, if you don't mind, can I step in and respond back next 30 seconds on this?
Would you like to make a remark or?
Yes.
Oh, please.
Thank you. I just wanted to share our India experience because we do allow in UPI the private non-bank players to participate back in UPI, and what it provides or enables is to give a great customer experience. So there are many non-bank, while there are many banks which are providing the UPI apps like SBI, Paytm, and others. There are non-banks who are providing the apps to the customers as well, which is Google servicing over 100 million customers on a monthly basis. PhonePe is servicing about 150 million, 200 million. So majority of the non-banks bring in the great innovation and the great customer experience. Now, how do we enable all the challenges which are asked in this question of the boundary definitions, the compliances? So what we have done is we have given the access of UPI to the non-banks through banks, right? So there is a category which has been defined as PSP, payment system provider banks, and the non-banks and banks collaborate, banks as PSP and non-banks as TPAP, which is, we call it as third-party app providers. They collaborate with each other to access the UPI system while the settlement continues to happen with the banks. The second is the authorization and authentication are two critical activities in the payment system. We have completely kept it in the bank's domain, and this was possible only because UPI has a modern architecture We provided the encryption libraries to the app providers, whether it's a banks, non-banks, where the customer PIN and all the confidential data is addressed, so that the activity of authorization and authentication happens purely in the bank domain. As Mr. Shin said, we have put up a very high bar for all participants in UPI in terms of compliances, in terms of security standards, to be part of the app before even participating to offer the service back in UPI. The stringent rules and regulations have been defined for the liability shift in case there are data breaches or the compliance breaches to the banks and non-banks together, to ensure that we are able to operate the safe and secure system. So we deal with this day in and day out, and obviously I can't explain in 30 seconds all the rules and regulations, but it's a journey, and I think RBI has played a very pivotal role to create a sound and safe environment with the stringent compliances and standards to make this banks and non-banks collaboration work. They also created this data storage guidelines in India, I think, which was very, very vital, because the processing may happen outside, but the data storage has to be permanently back in India. No provider can store the data outside beyond 24 hours. So I think these were the efforts taken to make this work. But let me tell you, today 5 billion transactions with variety of on a monthly basis with variety of players, banks and non-banks. I can say that this is the only payment system in the world is able to offer this kind of experience to the customers in India. Thank you.
Thanks for that, Governor Seth, Aput, Mr. Shin, and Mr. ASB. Truly, regulators have to strike a careful balance between managing risk without stifling innovation, while working closely with other players in the digital finance ecosystem. Now, may we ask if anyone from the speakers or panel want to answer this next question? Maybe Dr. Clapper may want to take this one. Post-pandemic, poorer emerging market economies may suffer permanent scarring, which widens inequality. What international reforms or initiatives can be done to support recovery and rebuild sustainable financial resilience for such countries? Dr. Clapper, please.
Thank you. So first and foremost is focusing on financial stability. So yeah, in the early onset of the pandemic, governments around the world took unprecedented steps, fiscal, monetary, financial sector support programs that had, in some cases, never been used before. These include debt moratoria, delayed credit reporting, in some cases, regulatory forbearance, which has hidden the true balance sheet risk on banks' balance sheets. And so, as mentioned earlier, certainly a first step is helping individuals deal with sustainable financing. Work with work with financial institutions to both identify and reveal and manage their distressed loans, work with individuals, if necessary, through strengthening insolvency frameworks to deal with sustainable private debt. But what's important to recognize is that we know from experience that weakening financial sector balance sheets has regressive, disproportionate impact on riskier, more vulnerable borrowers. So in conditions of bank tightening, it's typically the lower income households, smaller businesses who face credit constraints. So that said, going forward, this is a very broad answer. It relates to the nature of jobs, rebuilding irregular incomes. We've been focusing on access to credit, for example, which people, especially small businesses, might be looking for in order to rebuild their businesses and grow going forward. Something we've seen in during the hopefully the soon-to-be recovery stage is the greater challenges in credit risk assessment. That it's harder for banks to assess the true performance, for example, of small businesses, of entrepreneurs. given the fact, for example, that your past credit performance, your past credit history may not be a very good predictor of your future performance in light of unexpected shutdowns, et cetera. And this moves towards more real-time, both to get greater credit products that allow for both better visibility into the true credit risk of borrowers, as well as better recourse in the case of default. So that's on the credit side, and I share very strongly the opinion of the panelists, on the importance of additional consumer protections around new forms of fintech-based credit. Perhaps other opportunities, just to mention, involve various. Going forward, we need to look at better ways to encourage people to save, to insure themselves in a responsible way. That's out there.
Okay, thank you, Dr. Clapper. This question may be, well, I direct this to Mr. Shin. A conjecture in the success of PIX in Brazil is the compulsory participation of banks in the system, given the strong hand that the central bank had in setting rules for the public square. But in other jurisdictions, this has not been the case, and success of public provision has not been as strong. Would you think CBDC is a stronger institutional arrangement, given that central banks have a clear mandate and monopoly in the provision of legal tender? Therefore, would leapfrogging instant payments towards CBDC better solve coordination problems?
I think that's a very good question, and I very much share I think the conjecture is very much on the ball. As the questioner said, for PIX in Brazil, banks above a certain threshold size are required to be members of PIX, and for the smaller banks, they have the option of joining the system. And the way that the system was set up, perhaps the most difficult infrastructure here is setting up the digital ID system that is at the heart of the infrastructure. In India, there is the Aadhaar digital ID framework. In Brazil, what they did was to follow a much simpler way, which is to use an alias database, essentially using either your mobile phone number or some other ID, and having a central repository for those user identification. It's not quite a digital ID system, but it's enough to operate the whole system. And I think what this, and by mandating all the large banks to be members of PIX, what this enabled the authorities to do is to enforce the competitive level playing field. And I think this is a very important difference from simply imposing additional regulations on the private sector-led payment system itself, in that there are things you can do with direct provision that could only be imperfectly done through regulation. In that typically in an emerging market or in a developing economy, the payment system is operated primarily by the incumbent banks themselves as a bank-led infrastructure. And although the technical standards may be there, the incentives are somewhat different. If you're already an incumbent member of the system, the incentive to roll out a new system, which is cheaper, which is potentially going to eat away into your current profits, would lessen the incentive for you to provide that service. And here the public provision plays a very important role because the public provision of that public good enables the setting up of an open architecture that goes well beyond the existing infrastructure provided by the commercial banks themselves. The other question about whether there is a need to leapfrog this type of open and competitive retail payment system towards a CBDC, I think is an interesting question. My own view, and I think this is, I'd be interested in the other panelists' views on this. My own view is that if you do not have an open system like UPI or like PIX, then of course the much lower hanging fruit is to provide the infrastructure which will reap some of the rewards that come from that open system, rather than going all the way to a CBDC. I think there are much lower hanging fruit for the authorities to pursue than simply the CBDC itself. And I think this is also, of course, very true for the advanced economies. So, for example, you will have seen that the Federal Reserve recently published its paper on CBDCs, and it laid out some of the consultation questions. But in the US, there is yet to be this kind of open system, but there will be through the FedNow system, which is due for rollout next year, something which is more akin to these open and competitive payment systems. And in that respect, the FedNow system may be a much more realistic and more desirable step than going all the way to a CBDC, or at least that would be a very natural first step. And in that spirit, if you think about the overlap between what you need to have a CBDC and what you need to have an open retail fast payment system, in fact, there is a great deal of overlap, because you need to have a digital ID system. You need to have the APIs, which will ensure privacy of the transactions. And all of these data architecture that is a necessary condition for open retail fast payment system are exactly those you would need for a CBDC. And therefore, you are not actually foreclosing any options by taking the intermediate step of having the open payment system as an intermediate goal.
Thank you, Mr. Shin. May we refer this next question to Mr. ASB, who can draw on India's experience on building a thriving digital finance ecosystem. The question goes, should interoperability be promoted via natural market competition or via regulatory support or catalyst?
Thank you, Governor Benjamin. I think the regulators' role to drive interoperability is super important. I think if the regulator is not clear to have a payment system which is non-interoperable or closed loop, can be extremely detrimental to grow the ecosystem in the country. When you look at some of the large countries, right, and taking an example from China, the two closed loop wallet providers are very big, and it does not have the required efficient interoperable system. The ecosystem is always going to tend to create a closed loop networks. I think the regulator's role and diktat is super important to have the interoperability as a design principle to build any payment system in the country.
Okay, thank you, Mr. Asper. Now on the last question, maybe anyone can answer this. The link between financial health and macroeconomic stability have not been well studied. How do you think can widespread financial health challenges affect fiscal policy and financial sector stability?
I'm happy to give a short answer. So I'm director of this year's, I'll give a plug for this year's World Bank World Development Report, will be published on February 15th, is entitled Finance for an Equitable Recovery. And specifically what we look at are these interrelated balance sheet risks of firms and households, financial institutions, and government balance sheets. And so precisely to get to your question, as I mentioned earlier, the suffering on households and firms' balance sheets is directly affecting financial institutions through weakening of their balance sheets and this growing, perhaps hidden debt problem of banks, not even necessarily fully measuring the amount of distressed loan assets on their books. Regarding fiscal policy as well, it works in one direction, that as during the COVID pandemic, tax base has fallen, tax revenue has fallen for governments as incomes have plummeted. In addition, the necessary ongoing financial support has put a strain on many government sovereign debt loads, which have increased the response to the crisis. And so the question is, it's important to recognize these interrelated balance sheet risks, and that the risks of households, the risks of financial institution balance sheets could have spillovers on the broader economy and on inequality. As I mentioned earlier, because of the aggressive nature, for example, of bank tightening, because we know the aggressive nature of the pandemic that disproportionately affected working mothers, workers with lower education levels, these all created financial risks, and a policy priority going forward needs to be to help these more vulnerable populations build their financial resilience.
Okay, I guess we're running out of time. So thank you, everyone. That was a very fruitful discussion. And I believe that we can all agree that the key issues and points raised by our speakers and panelists are valuable and can inform our path forward. Indeed, it forms part of our future policy discussions and considerations when we get to tackle financial health and resilience back in our jurisdiction. Once again, thank you to the organizers of this virtual conference for allowing me to chair the discussion and share the stage with our speakers and panelists. I look forward to seeing you again, hopefully under better circumstances. May everyone stay safe and have a pleasant day or evening ahead of you. Thank you.
Hello, my name is Zamil Al-Sabhan from Saudi Arabia, and I'm a student in the Master of Central Banking program at Asia School of Business. Today's discussion reinforced for me the importance not only access to finance, but also the wide range of factors affecting the financial health. I hope you enjoyed it like I do. I would like to reiterate thanks to the speakers, panelists, and chair for a great discussion. And I want to give you a preview of tomorrow's session. Tomorrow, the topic is central banks as enablers. We have a keynote address by Professor Robert Merton from MIT. Governor Noor Shamsia Mohammed Yunus from Bank Negara Malaysia will be your chair. We will have two speakers, Dr. Henry Olsen from the Swedish Riksbank, and he will talk about the central bank digital currency as an enabler. Dr. Fernando Ristoy from Financial Stability Institute, and he will talk about regulatory innovation. As panelists, we look forward to hearing from Mr. Ravi Menon from the Monetary Authority of Singapore and Mr. Eddie Yue from the Hong Kong Monetary Authority. Good night, keep safe, and look forward to see you tomorrow.